Right, guys, welcome. Today is obviously Sunday evening, 8 o'clock. So ready here to get started. And so we obviously had a pretty good week last week. We had obviously, 100% win rate Monday, Tuesday, and th Thursday. Wednesday was the afternoon. We did well in the morning, and obviously, yeah, we just had a few stops hit in the afternoon. So obviously that's why that was a red day, and then obviously yesterday was a good day as well. Sorry, yesterday, Friday. So happy. Um, for anyone who's new here, I'll obviously go through everything. If you've got any questions, write them in. Happy to answer. And obviously we can go through anything. So what I've done, very kind of similar layout to obviously what is happening. What's been happening, and obviously what I like to do is to give a few things for everyone to kind of have a look at. So first things first, let's obviously go through what is happening. Like I always say, you don't have to fully understand it, but everyone can be aware of obviously what's happening, what to watch out for. So we've obviously got Monday. Um, Tomorrow we've got a bank holiday in the UK. I think a bank holiday pretty much all over Europe and a bank holiday in the US as well. So expect tomorrow to be a bit slow. I'm going to put some trades out there, but obviously I've got the expectation that it's not going to be a heavy day for us, But yeah, I'm still going to still going to put some trades out there, but obviously we'll see. Mondays tomorrow is just going to be hype and expectation. We're not going to get huge moves. So it's about just taking what we can, not obviously expecting, huge magical things to happen. All right. Tuesday, not a lot really to report. Consumer confidence will be important. That's the confidence that obviously consumers have in the US economy. So expected to drop ever so slightly. So that'll be interesting. We then got inflation data for Aussie. And then obviously we've got ADP employment change for the US. Not a lot really else to look out for. Potentially going to keep an eye on the press conference for Euro, but not really looking at it that heavy. We've then got Thursday, mainly PCE and GDP as well, and jobless claims. So Thursday is going to be a pretty big day for the US. We've got obviously all of this data here, so a lot coming out on Thursday, and then Friday got GDP for Canada, retail sales, little bit of PMI, but apart from that, oh, we've also got inflation data for Japan. I am gonna basically what I will do, I'll print off this PDF, or not print it off, but I'll post it in the group afterwards. So you guys are obviously going to be able to understand what is happening here. So main things we're going to be looking out for, as always, the dollar. Um, Yields here. I've done put some markings in, all right, of things to be aware of here on yields. And I put some markings in for oil too, all right. And obviously I'll go over these markers once I've obviously gone through the PDF. But oil is a very big kind of factor at the moment. It's our inflation gauge, So for anyone who's not in the inner circle, we do have to be aware of inflation. We need to be open. That obviously that is the main driving factor at the moment. So oil is probably the best inflation tool out there. As long as oil is basically above 90, then there's going to be worry in the market. All right. So imagine this like red, amber, green, like a traffic light here. You got obviously red, anything above 90 is a bit of a worry. Below kind of 80 and 90 is kind of cooling, it's indecision. Below 80 is where we want oil, really, because that'll mean that there won't be as much worry about inflation, and we'll be pretty much back to normal here. So these are obviously some of the things that I'm going to go over tonight. So what I normally do, I'll go through the PDF quickly, and you guys will obviously have this after to, look over, and obviously hope it's going to help you to set out. I want to try and do these every Sunday now because they do help as a bit of a blueprint, as to, what's obviously been, you know, uh, um, happening here, right, one thing I want everyone to understand right now is that the market is not moving normally. This is not a technical market at the moment. We're in a very headline-driven environment where geopolitical news, oil prices, inflation expectation yields, and central bank pricing are all connected together. All right. The market doesn't just care about conflict. The market cares about what the conflict could potentially do to oil prices, inflation, interest rates, global growth, risk sentiment, central bank policy. That is where the real money is focused. All right. So everyone here, all right, has probably learned their, lesson the hard way, all right? In the past, war comes, gold flies, all right? This war has been slightly different because it's all based around oil. And because oil is the key to the world, right now, unfortunately, I think even for me, it's really hit home how important oil is, and how important the price of it is. And if it gets out of control, anyone who's importing is going to be worried. All right. What's happening with Iran? There's a brief, obviously, outlook here. Most people are focusing on the actual geopolitical situation itself, but from a macro perspective, the important part is whether this becomes an inflation event, which it has been. All right. The reason traders and institutions are watching around so closely is because of the impact it could potentially have on the oil supply and shipping routes. So all anyone's worried about that they're not actually worried about bombs, flying, is talk around the Strait of Hormuz. That is it. All right, that is what everyone, for anyone going straight back to basics here, if that is open, everything is cool. All right, if it's closed, because it's obviously one of the biggest, shipping routes in the world for oil, obviously, and energy. All if it's blocked, all prices rise, shipping costs rise, insurance costs rise, and inflation rises. All right. And if inflation starts rising, central banks become more cautious about cutting interest rates. So I went over this in quite a bit of detail in the boot camp, last week. But if obviously inflation is high, there is a worry. All right. And obviously, think about inflation as a bad worry. All right. Because, you'll obviously have the dollar strengthen, if obviously employment's great, if GDP is great, they've cut interest rates, but they're cutting them into a strong market. All right. So the dollar will pump still because it is pumping off of good stuff happening. All right. Inflation is the opposite. All right. They're gonna, Europe's dealing with it right now. Aussie, US, UK, everyone's worried. All right. So what do? They whack interest rates up. All right. Because they are worried. They don't want internal spending. All right. They don't want their people to be spending. So higher interest rates makes things more expensive. All right. But what does it also do? With a higher interest rate, it means external investors can bring their money into that particular currency and they're going to make more on it. All right. Think about it. If an interest rate goes up 0.25% or half percent, it means, for every, we're not talking, millions here, we're talking hundreds of millions, billions. That means an extra 0.5% on their, money. All right. So really, really think about it. But it will strengthen the dollar in a bad way, in a worrying way. So as much as it can come in, and obviously that's the worry at the moment, comes in really, really quick, it can come out really, really quick too. All right. Whereas if dollars being supported by a strong market, then obviously, it's going to be a lot, nicer to obviously invest into. And yes, this is the key connection. Most retail traders, which is probably 99% of this market and probably in this industry, especially the industry that we're in, that you will find 99% of the guys do not have a clue what is going on. They might speak about inflation and interest rates, but they don't understand, and they don't understand how they can use it as a tool. All right, makes trading easy. All right, so oil, why oil matters so much right now. At the moment, oil is arguably more important than economic data in the short term. A lot of traders are still focusing heavily on CPR reports, NFP numbers, but right now, oil is feeding directly into inflation expectations. If oil moves aggressively higher, inflation fears increase, market reduces expectations for interest rate cuts, yields can move higher, USD can strengthen, risk assets can struggle. This is why institutions are watching crude oil extremely closely. Oil is no longer just an energy market, it becomes a macro driver during periods like this. Right, so now we're going to come into these lines here, all right, that I've drawn out. So I'm going to put it on a daily time frame just to obviously keep it, going good and obviously making sure it's nice and clean. Right. So get back on my page. Right. 75 to 80, right? This is the ideal area. All right. This is this area. This is where markets become happy. All right. Markets become very, very happy. Let's put this box here in green. All right. Oh, put the box here in green. Green. There we go. Green is good. Right. Green is good. So if oil stabilizes around this area, markets may calm down, inflation fears stay controlled, and central banks may continue talking about cuts later on in the year. This is more of a manageable inflation zone. 80 to 90, this is where things become more important macro wise. If oil starts pushing aggressively into this range, inflation expectations can rise quickly, bond yields may start climbing, and banks may become more cautious. At this stage, markets start questioning. All right. So that is this area here. All right. It's a little bit nicer than where we are right now, but obviously it's still a bit of a worry. And then we've got our next area here, which I might as well mark it up now as I'm on here. This is our the danger, zone. All right. So think of it a little bit like a traffic light area. All right, so that is 90. This is where markets can become very uncomfortable very quickly. If oil aggressively breaks above 90 and remains elevated, inflation fears can re-accelerate. Rate cut expectations can get pushed back. Yields may rise aggressively. US dollar strength can return, and equities can come under pressure. This is where oil stops just being a commodity and becomes a full macro problem. So hopefully you guys are kind of understanding like I am. Yeah, and obviously I've been doing this a long, long time, and obviously this is probably one of the times where I've really, really, because I guess I've understood everything, I've really, really, noticed how everything, yeah, is revolving round oil. So ideally, what we would like is for everything to chill, all right, come in to potentially start off this area and then get some cooling. What we will find is once everything's agreed and open, you will see oil start to trade probably for a while around this area here. All right, because it's not going to just magically go back down, and I don't think it's going to hit these areas in a hurry either, because we've obviously got a long way to go before obviously everyone, agrees and is happy. But obviously if you use oil as a bit of a traffic light, system for inflation, then obviously it's going to give you this edge, all right? Because once this drops, what's that's going to do? It's going to drag up pound against the dollar. It's going to drag up euro against the dollar. It's going to drag up Aussie. It's probably going to drag up gold slightly. It's going to drag yields down, and then yen, yeah, will probably start to tumble properly. All of these things will happen because of oil. All right. But obviously, we need oil to get into this stage. Fast breakthrough. You can see here. Yes, we obviously had that drop when we had the 2 week ceasefire, but then everything's crept back up into this kind of danger zone area. So think about it as a bit of a traffic light. Why yields matter so much. So I go over this time and time again because obviously I want everyone to understand. US 10-year yields is still one of the most important things to watch in the market. Yields are effectively the heartbeat of macros. All right. So if you do not understand, just start watching the US 10-year yields. Just see how it correlates with the dollar and also correlates with gold too. So it should indirectly correlate with gold. Yields go up, that's going to drag gold down. Yields come down, that's going to push gold up. All right, that's what normally happens. It doesn't happen all the time, but we've also got two areas here because as well as oil, yields are also a little bit out of control too. All right, they're a little bit out of control too. Very simply, higher yields generally support the US dollar. Lower yields generally weaken the US dollar. Rising yields can put pressure on gold and equities. Falling yields can support risk assets. A lot of new traders ignore yields completely, but institutions absolutely do not. All right. So just like oil, so below 4.2 would be an ideal scenario. This would normally suggest inflation fears are easing, markets are pricing more confidence in rate cuts, and risk sentiment can improve. This environment can support equities, so stocks, euro, USD strength, GBP USD strength, and potentially gold stronger moves. So 4.2, believe it or not, and we'll obviously draw these in two. So this is our green, all right, and then we've got our orange, which is our like amber, zone, all right, where things should start cooling. We do need this dropping slightly, and then anything above here, we're gonna have to put it in the red bracket here. All right, anything higher, we're going to have to put this in red because that is where it is right now. You can't write yields off, but obviously, again, great inflation under control. Inflation's starting to get there potentially out of control, hard markets to trade. No one really knows what's happening. All right. I'm just putting this into perspective because it's true. It's hard. All right. 4.2 to 4.5, like I explained, neutral and above 4.5, that's obviously where we are right now. It's very, very, very tricky. All right. Why does inflation expectations matter? Obviously, I've been through that, so I'm going to skip that. Um, right, gold. Why gold isn't reacting like everyone's expecting? All right. Normally, people expect gold to explode higher during political tension, but recently, gold has not been reacting as aggressively as many expected. Why? Because of yields and the US dollar are still having a huge influence over gold pricing. All right. So for all you gold traders out there, this is the chart you need to add in. All right. Yields, you have to be watching it. You have to be. All right. Because with yields screaming higher, I've had so many ICT traders, saying that there's so much liquidity to the upside. Markets need to retest it. They don't. All right. The markets will only retest it if yields go into this area. And what a head start you will have if you understand that yields need to be in this area for gold to push up. Yeah. If yields drop into that area, we will then come up and test this liquidity. Yes. But until that happens, gold has got no hope in testing those highs. All right. So even if geopolitical fear exists, if yields remain elevated and the Fed is expected to stay restrictive, gold can struggle to trend aggressively higher. This is why simply buying gold because of scary headlines can be dangerous. What hedge funds are looking at? A lot of hedge funds right now are trading very tactically rather than holding the long-term conviction. This means markets can reverse aggressively because positioning changes quickly. Funds are watching oil, US 10-year yields, the dollar, central bank expectations, shipping disruptions. Now, I had a meeting earlier on this morning with my friend because he only lives around the corner here. He obviously works for Deutsche Bank. Now, I can't say exactly what he'd said, but obviously everyone in the fund space is very cash rich right now. They are getting ready to obviously, happy for quarter three to be a little bit, slower or quarter two, but obviously quarter three they are ready to, make up for it, hugely. So that is the kind of higher kind of that's the expectation of that space is that they're all holding quite a big proportion of cash and they are ready. Once, yeah, they obviously get a good kind of, view of what's happening. All right. Last but not least, because I've had a couple of you ask me about this, understanding the Japanese yen. All right, because we obviously understand that, yen, right, is there's a lot of, heavy, selling pressure here. All right, you can see this on, say, a 4 hour time frame. Every single bullish candle is quite small. The bearish candles are a bit big. That means there's a lot of, selling pressure here. All right, more selling than buying pressure. Look how small all these candles are, and even when they are, the biggest amount of volume is wicking to the downside. That to me tells me that there is heavy, sellers here, and obviously buyers are kind of getting to a point, taking profits. So Wade, sellers take over, buyers come straight back in. So it's been one that we I don't think we traded USD JPY last week. We caught these two moves on the week before, but obviously we've not traded it last week, and this is why. All right. A lot of people just see USD to JPY and think it's random volatility, but USD to JPY is actually one of the biggest reflections of yield expectations, central bank diversion, and overall market sentiment. The yen is heavily influenced by the difference between US interest rates and Japanese interest rates. This is why US yields matter so much for USD JPY. Why USD JPY reacts so aggressively to yields. Japan has an extremely low interest rate for years compared to the US. So when US yields rise, investors can earn much higher returns holding US dollar assets. Money flows into the dollar and USD JPY tends to rise. But when US yields fall, the attractiveness of holding USD weakens. The yen can strengthen quickly and USD JPY can reverse aggressively. This is why USD JPY often becomes one of the cleanest yield trades in the market. Sometimes USD JPY is not even reacting to technicals at all. That's why yen is so hard to trade. You can't really technically trade it, especially in times, like this, because naturally, if yields drop down into our amber, zone here, that is going to send USD JPY probably below here. All right, we're probably talking these, levels here, and it will happen aggressively too. All right. Uh, uh, everyone hopefully understands why yen is considered a safe haven. Key USD to JPY areas to watch: rising yields and rising USD JPY. This normally suggests stronger US demand, tighter financial conditions, and markets pricing fewer cuts. The environment can pressure gold, equities, and risk currencies. What was one thing that I was going to go over? It was about a trade, I think. Why yen is important right now. Right now, the yen is becoming increasingly important because markets are trying to figure out whether US yields remain elevated, whether inflation stays sticky, and whether central banks can actually cut rates aggressively. All right. So, there's lots and lots of, different kind of scenarios here, but actually having these kind of amber, zones, hopefully this has explained everything a little bit easier for everyone. And you should start to understand it, a bit better, in regards to obviously what to watch out for. All right, so oil, we're obviously using this as our inflation tool only. All right, so as long as oil is in this danger, zone here, there's going to be worries about inflation. That's generally going to mean that the dollar and yields are trading higher. All right, you can't really bet against even yields here. All right, we can't really bet against yields until they break below this 4.5%. All right, and if yields are trading higher, then we've got to look for this dollar, strength here. Naturally, leading into something like GBP, USD here, although it's not been moving, I would say very much at all. Nothing really has. You can see here, everything's been kind of moving, sideways. We are still, if we box up, all right, and here's an easy way to explain it. If we box up here, all right, this is our highlighted price here. All right, if yields are still trading in the red zone, if oil is still trading in the red zone too, which it is, that's going to mean we're going to want to support the dollar. All right. So that doesn't mean we just come in and, and sell from anywhere. We then hand pick our places. We want to, what they call here in markets like this. So we should have hypothetically either a trending market, right? Oh, we should have a these are the three types of market here. Oh, there we go. Sorry, this one here. We're going to have sideways market, which is kind of what we've got right now. And then we're going to have an ascending market, a bullish market. Yeah. All right. So in times like this, we can, before we've looked at any of these charts here, all right, before we've looked at GBP USD, Euro USD, AUD USD, gold, and USD JPY, we look at oil. All right. Oil is in the red zone. So we're already thinking, right, you know what, inflation still a bit high. All right, yields in the red zone still supported. Yes, we've got a little bit of a short-term trend coming here, but we know this is our kind of mark here where if it breaks into this area, everything's starting to cool and people are going to start to chill slightly. All right, so we can then think, right, you know what, dollar still trading above 99, so we want to be looking to buy from the dips, not buying from where it is. All right. So if we use GBP USD for example here, we're trying to buy, or sorry, trying to, sell from these areas here. All right. We're trying to sell from these areas here only. We're not interested in any of this here. All right. None of this stuff here. We're not interested in trying to grab a quick trade to the upside. We're only interested in catching the proper trades that we want to take. Yeah. So we'd be looking, right, you know what, this area here, we might potentially be, if this one breezes past, we might then be looking at this, potential area here a bit higher, or potentially, this area here, a little bit higher. But obviously, we're not looking to buy because that is going to go against our overall outlook. All right. But as you can already tell, for those of you who are, new to obviously what I do here, all right, I identify which way I'm going to take my GBP USD, AD USD, Euro USD Gold, USD JPY. I'm identifying which way I'm going to take them by looking at the dollar, by looking at yields, and by looking at oil, and potentially just glancing at equities. All right. But because of that, I obviously know, right, you know what, this is still angling to sell the dollar, sorry, to buy the dollar against pound, euro, Aussie. All right. And so then all I'm worrying about when I click on this chart here, all I'm worrying about is where. All right. Where I'm going to sell. All right. And I've got all of these options here. Right. I've got a few options depending on liquidity that obviously I could take hold of and capitalize on. So it all depends how aggressive I want to be and where do I think price might come back to. If we wake up in the morning and price has done something like this where it's creeping up, but obviously it's a bit messy, potentially I might be looking to, sell from here. Yeah, down into this area. All right. If price has done something different, where it's kind of crept a bit lower, but then it's come back up, I'll be looking to, to sell from here. But I've already got one, two, three, four reasons why I'm going to take this trade. All right. Four reasons why. Because of oil, because of the dollar, because of yields, because of equities. And that is, we always get told, yeah, we need five confluences. And I think the mistake that everyone makes is they're looking for candles, they're looking for, support, resistance. No, you want to start to top that up through your, macro outlook and trend. These one, two, three, four sets of charts give you all of that. And it's very, very easy, like I've explained here. Right, let's go through some of these questions. So I think Alex has gone, so I'll skip him. Ian, so interest rate rise is good for a country's currency globally in terms of its strength. Yes, all right. So it's good in a bad way, all right? Because a country or a currency economy will increase interest rates because the economy is not doing great. And they want to do things like reduced spending. They also want to bring in some external, money because, yeah, their currency is kind of, lacking. All right. So, yes, like for example, if you're getting 4% here, but you can get 4.5% here, you're going to swap money around and put it here. Yeah, that's obviously what big money does. It will follow the higher interest rate, but a higher interest rate is designed to reduce, spending. All right. So, for example, in the UK here right now, we've got mortgage rates up, we got car finance up, we got bank loans up. Everything's more expensive. All right. But if say, interest rates start coming down, if it's cheaper to borrow more, everyone tends to borrow more. All right. Think about the central banks probably look at their economy as managing children. If you give someone too much and it's too easy, they're gonna carry on spending but get to a point where it's a bit out of control. You then raise interest rates, makes everything a bit harder, stop spending, curbs everything back. All right, so that's kind of how it works. Does anyone have any questions? Any questions for any more? Any more for any more? I will obviously put that PDF in the group, but obviously, yeah, so you can go through it. Noel, how do you see all trending this week? So, I mean, all we can judge is over the weekend. We've obviously had a few tweets from Trump saying that he's not going to close the Strait of Hormuz. All that is going to do is take oil higher. Now, I actually don't think it's that much of an issue, but I do think we don't have enough to drop us down into this amber area. So I can see oil doing something like this personally, unless, something happens. And obviously, that's the main thing to look out for here. All right, is that no one, it could change in the drop of a hat. All right, that they could come out and say, you know what, we've agreed another month, ceasefire. No one knows it's coming, and then it all drops down to this area here. All right, or they could say, you know what, US is gonna bomb Iran, and then we're then back trading up at these highs here. Yeah. So anything can happen at any time, and that's what's making trading a little bit horrible. So, for example, trading gold, if we're looking at yields and oil, how can we decide if our entry exit, like if we look gold and oil, they are reacting spontaneous. If oil and gold has a time difference in reaction, then we might take the decisions, but a bit confusion as oil moves, gold moves spontaneous. So, let's obviously have a little look here, right, on gold, because I wouldn't say gold's been moving spontaneously at all. I don't think it's been moving huge. We've got about 1,000 pips here, which is nothing for gold. If you don't look at how gold's been moving, it's pretty small. Especially last week from top to bottom for gold was like 800 pips. All right, it's not really that crazy at all. So but obviously naturally overall, if yields are high, which they are, and if oil is high, then surely with gold, you're not going to be looking to buy. All right. But you want to then be highlighting the areas where you could potentially, sell from. Because if you're going with technicals only, what would everyone have done? Bought from here, yeah? They would have bought from here, or potentially here. Nice, yeah. Trends changing. Don't worry. We've had this bullish candle. It's going for it. Even if you'd have gone from here, it's tested half this candle. I've got the perfect entry. You would be coming in to the weekend in drawdown. All right. I promise you, once you get away from trading technicals only, by all means, if it helps you, use technicals for entries. All right. But you need to understand if yields are trending in a higher place, if dollar is holding above 99, if oil is trending, don't look at the short-term outlook. Zoom out, look at the whole picture. All right. But before all this happened, oil was trading down here. Yeah. At like 69. That's its happy place, probably below 80. All right. But anywhere above 90 is worried. So all I would be looking for gold is just looking to, sell from all these highest points here. And actually when you include this, it makes it very, very easy. All right. Don't look at trading in small snippets. All right. Look at the overall picture. Does anyone have any more questions? Any more for any more? Happy to answer. And hopefully this has obviously helped everyone. Hopefully you've enjoyed it. Tom, how long should we be looking back on charts when deciding to find correct trend? Is that particular week or longer? I would be looking, so, for example, yields here. Yeah. Right. and oil for anyone who's interested, right? Mark up oil from when from when this war kind of started here. So let's mark it in pink here. Yeah. All right. This is kind of when the market started. Yeah. So if we make this a bit of a chunky one. All right. So for anyone to start buying oil, buying gold, going against the dollar, you do need to be trading back down to these areas because as long as we're above, it's going to be worrying. Yeah. All right. So that's obviously what you've got to look out for. But draw these traffic lights on your oil chart and your yields chart. 'Cause I promise you, it's going to really help you. Yeah. Thank you. Great session, Dan. Great session. Thank you. Amazing, Dan. As always, for anyone new, make sure you join. Best decision you will make. Well, hopefully, yeah, like I'd said, hopefully everyone's gonna, start to obviously understand and obviously add these bits in, add them in because it's going to really help you. Yeah, so right, hope everyone has a great Sunday evening. Remember, I do not recommend to trade on a, Sunday evening. Let's wait, watch Asia, and then, go from there. So that is what I would recommend. So yeah, but no, have a great evening, and yeah, let's absolutely smash it. Have a good one, guys. Have a good one.